Hey everyone, Jeff Dorman, Chief Investment Officer and co-founder of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets, as depressing as it may be for the last couple of weeks. Joined this week by my partner and research analyst, Topher Macpherson. Hey, buddy.
Hey, thanks for having me on, Jeff.
All right. So for those who don't know, we write a blog every week. We talk about all kinds of different things happening in the markets called That's Our Two Satoshis. It's on our website, ar.ca/blog. This week, a lot of really good charts in there, talking about anything from how DeFi is generating almost 60% of all the revenue happening on chain, to debunking for the 8,000th time why MicroStrategy is not actually a risk to Bitcoin, because there is just no mechanism at all that forces them to sell ever. So do what you want with MicroStrategy stocks or converts or preferreds, but stop saying that they're going to be a forced seller of Bitcoin. It's not going to happen. To even talking about just, the obvious stuff like, hey, issuers of tokens, if you do investor calls and other token friendly operations, your token's going to trade better. But most of what we talked about this week was written by Topher, talking about buybacks. And I think, most of you have heard me talk about this in the past. I've been on record many times saying that I think the only point of a token is to buy it back and basically amortize it to zero. But Topher had a different spin on it, or an additional spin. First of all, Topher, why did you write about this? Like, what is the discord right now on buybacks? What is the problem with regard to the sentiment around token buybacks?
Yeah, I mean, I think a lot of it's pretty common in crypto. Like this happens all the time. There's a new concept that does very well. People get really excited about it. We kind of take it to extremes, and then it doesn't work out as well as they thought, or at least the way they expected. And then people are disappointed. But really, it comes back to like understanding what buybacks are to begin with, right? And so I wanted to write this just to help give like some color and some details behind really like what buybacks are and what they aren't.
Well, let's start with the obvious, right? The early days of crypto. Well, first of all, buybacks are, if you go back to just the stock or bond world, buybacks are not exactly a foreign concept, right? When you have excess free cash flow, you got capital decisions to make. You can invest in your employees, or you can invest in R&D, or you can make acquisitions, or you can pay dividends or buybacks, right? That's a pretty standard, use of cash flow in traditional finance. In the crypto world, we didn't get there right away, obviously, because Bitcoin is a cash flow less asset. So there was no ability to ever do any sort of buybacks. The next iteration after we got past all the Bitcoin forks was, of course, smart contract platforms. And, most of those were empty shells, at least in the early days, and we're, still years away from generating any meaningful revenue. And then, of course, I think Binance and BitFinex's Leo were probably the first two tokens to really, be issued by cash flow producing entities that had the chance to do buybacks. And it honestly threw the entire industry for a loop, in the sense that, even today, you look on like a CoinGecko or a CoinMarketCap, and they still don't know how to account for things like buybacks. And, the exchanges don't do a good job of separating this. So it's not a foreign concept from a finance standpoint, but it's still sort of a limited concept, at least in the token world, because there's so few of these entities. So let's start there. Like, of the few that are out there, why is this so divisive? Or what is the issue with just understanding that this is a capital allocation decision from the token issuer, and seemingly is good for investors?
Right. I mean, I think we spent so many years like in crypto talking about things like attention value, network value, Metcalfe's law. I mean, basically just saying every L1 should be $1 billion plus at its like base valuation. I think a lot of those things like have hurt investors quite a bit. Even just I always say just like basic supply and demand. A lot of these tokens are just filled with supply avalanches. And if you don't have something on the other end fighting against those supply avalanches, it doesn't turn out well, right? And so you can see it, in both the move up and the move down this year. The tokens that do not actually solve for the demand side of the equation really don't do well.
When you say supply avalanche, you're of course referring to just annual inflation, right? Whether that is programmatic, in the sense of that's the way the network actually incentivizes validators to run the network, or you're talking about I guess maybe, are you also including there just the cliffs from venture raises, things like that?
Yeah, exactly. I mean, to get the full value of a token, like your bang for your buck on using a token, well, you can't just issue it all up front. Like the team, it is a valuable, tool in a team's toolkit to help grow the protocol, right? And I think we give out maybe too many incentives at times when really it should be just slight amount of incentives for marketing and retention. And then with investors in the team, like that is how you align the investors in the team. Well, eventually that supply needs to come online, right? And it works slightly differently than equities in that way. And so it basically creates this need for taking supply out of the equation on the other side, or else it's just going to be constant unlocks where investors, like if they've done well and they would like to sell, like it's their right to. And same with the team. If the team has built this great protocol, they've made a bunch of money, their tokens unlock, like they should be able to sell. And that's unlocks is a whole nother topic, but you need something on the other end is basically the point.
Yeah, I mean, it seems pretty obvious, right? In the equity world, obviously the demand is created from ultimately the takeout value, the expectation that eventually somebody might buy the company. So they're going to be willing to pay some sort of a multiple on your annual cash flow to own the asset and earn that cash flow themselves. Or you're going to get a piece of that cash flow in some sort of a dividend or a buyback form. Same with bonds, right? You're expecting to get your interest payment on an annual basis. That's therefore that creates the demand, and eventually be paid back. So, because there is no, interest payment in crypto, because there is no takeout value from an acquisition, the only real way to create that demand side of the equation to offset any of that inflation and unlocks is to take your cash flow and buy back the token. Like, it seems like a pretty simple concept, and yet here we are again having to explain it because crypto has decided that if you do a token buyback, it means your token has to go up indefinitely and never go down ever again, which
Yeah,
is crazy. But it seems to be what we're fighting with. Is there are actually people out there who are like, no, buybacks are a bad thing. They don't actually help
right,
because look, the token fell 3% today.
right. I mean, that was kind of like the basis of the blog was that, Hyperliquid came onto the scene, did so well, and it does a 99% buyback. And they're very unique. And the reason why they can do a 99% buyback of their fees is because they used to be a market making desk, and they have an algorithm that basically runs all day long, and it pays for their OPEX. So outside of that, because all of their operational expenses are paid, they can do 99% buybacks. But most companies can't do that, right? You need to pay your salaries, you need to pay for growth, especially upfront when you are a new business and you're in hyper growth mode. You don't want to be just burning all of the money that you're making just by buying back a token and not getting any growth value out of it. And so with Hyperliquid, obviously it's been an amazing performer. It's gone up a bunch, and on top of that, they do this 99% buyback. So of course, like I said earlier, like the community sees that. They say, wow, everyone should be doing the same thing, right? Everyone should do a 99 or 100% buyback. And that will make your token go up only forever. And that's really not, it just, even the math on that doesn't work out. I talk about it in the blog. If you are a 1 billion valuation token and you're priced at a 20 price to earnings, right, which is a pretty reasonable price to earnings. If you break that down into hourly buys in perpetuity, it's like $5,700, right? If you're a $1 billion token and you're getting buys of $5,700, like the liquidity is going to be way larger than that $5,700. So it won't even move the price, right? So that's where when people think that this is like something that's going to pump the token and make it go up, like the math doesn't work out that way, and that's okay because that's not really the point.
Yeah. So in the blog, and by the way, I mean that sort of sounds obvious, which is that you know, yes, different companies have different operating costs and different needs. So there is a sliding scale between using none of your revenue to buy back tokens versus going all the way up on the other extreme and using 100% of your revenues to buy back tokens. and every company is going to have a different capital allocation decision and come up with a different number based on their needs and their growth plans and things like that. What I don't get is why all of a sudden that turned into buybacks are bad. It should be clearly buybacks are good. It's just a matter of how much of the buyback that you do that maybe you question. So in your blog, you wrote, let's go back to basics and explain this again, like what a buyback actually does. And you wrote basically four things, right? One is it creates four types of demand. Two, it connects the success of the project with the value of the token. Three, it strengthens trust in an otherwise trustless system. And four, it enables new inflows of capital to crypto. So why don't you go through, each of those and walk through kind of just your thoughts on the basics of like why are these buybacks important and what does this really do in terms of both token value and alignment of the project?
Sure. I mean, we can start with like the different types of demand that it creates. So we just talked about the actual buying of the token, right? That's real demand. Although, like what we said, it's more long-term value rather than short-term value. The second piece is what you talked about earlier, just amortizing demand. If you want to get the full bang for your buck out of a token, you need to bring more tokens online over time. Well, you need to have something that takes tokens out of circulation, whether you're burning it or you're doing something like Hyperliquid does, where they have their assistance fund, where it's just a vaulted wallet, basically, where the assumption is those tokens will never come back into circulation unless there's like a major emergency. And then the third piece here, I call it just like floor value demand. In stocks, when stocks go down, eventually there's always a bid because people look at these stocks as like they have inherent demand, right? And you're like, wow, that's awesome. I get to buy NVIDIA at a discount, right? And that hasn't happened in crypto because most of our tokens don't have real inherent value, as we talked about at the start. But these tokens do, and so really by doing these buybacks, you're creating kind of that floor value. And then the fourth piece, like I think it's super important, which is alignment demand. That's kind of just what I'm calling it. Basically, in crypto, we used to do governance voting, and we tried to run startups that way. It just doesn't work well. Like, governance is still important, but for major decisions of a startup, sometimes like you need to be really agile as a startup. Sometimes you need to make decisions that are just not popular, right? And so by giving back a lot of that discretion to these founders, well, what's the net effect here? Well, the net effect is that the founders then need to show through their actions how they're actually still aligned with token holders. Why will they not just run away with the money or do something that's really damaging to token holders? Well, that's where the alignment comes in. So if you're a founder and you have this massive treasury, you could just walk away. But if you're actually buying back the token, that's all money that you're showing the community that you are basically incentivized by the same thing as them. You will always therefore in theory like make the decision that's always what's best for them as well. And I think that's very important.
Just pausing on that one for a second, though. I mean, like the same is true, obviously, in the equity world as well, though, right? I mean, it's very rare that anybody running a company doesn't have a significant ownership of the stock. So, again, it's sort of like something that you just take for granted in the equity world. Although, many investors will look at that and they want to know what percentage of the stock, management owns and things like that. Like to be fully aligned and fully incentivized is sort of the same thing here, which is what you're saying here, right? Like you want to not only have management incentivized, but then use the alignment of the growth of this entity to pay back everybody else, including investors and management and stuff like that. Like it's again, I guess the part I keep going back to is like, why is this not obvious? Like tying, there's seemingly no other way in crypto, unless I'm missing something, to tie all of the participants and the growth and revenues of the business to a token other than buybacks. Like, so I guess that's what I'm pushing back at. Like, what's the other side of the argument? Because this stuff all sounds obvious to me.
I don't know. I mean, I think it's that. I mean, like I said earlier, like I think for many years there was investment into really impressive tech at the venture capital level into these different protocols, and they all would come with a token. Well, the token, it was needed to pay for validators, and then they'd also use it as incentives to pull more people in. But that's all supply coming out. Where's the demand on the other side? And I think the argument, I actually saw one last night, which is that just narrative value matters more. That we now live in this attention economy where the GameStops or the Zcashes, some of these other types of lesser fundamentally designed tokens or assets can be the better performers, just based on the amount of eyeballs that will come in and see it, and then you expect someone else to buy it, and then it's kind of a kumbaya together, right?
But even that, I mean, again, like I know we sometimes bust on the VCs and some of the other investors in this space who are just all about network effects and growth for the sake of growth. But like even them, in the back of their head, they must know that eventually that growth has to actually lead to one of two things. It has to either lead to revenues, which you tie back to your token via buybacks, or it has to lead to so much demand for the token in terms of actual usage, whether that's because in the case of like an L1, you have to own so much of it just to run your business. Like there has to be an end game. It can't just be growth for the sake of growth with no end game. Like even the dumbest, loudest people on crypto Twitter have to know that eventually it has to lead to either an actual supply sink or a revenue story.
Well, I mean, it worked for Bitcoin, right? And that's that's the one exception in my mind, because
Oh,
it's
Bitcoin,
it's
Ripple,
not meant to be a
Dogecoin.
network in the same way.
I mean, there's been a couple examples, right? Bitcoin, Ripple, Dogecoin. So I guess that is that there's enough people who continue to look at the anomalies and think that's the norm, rather than recognize that they're anomalies.
Enough people that I don't want to say fool into things, but you just make them believers, and some of these, I guess, traditional techniques for valuing things, it just supersedes it. Um, don't know any other way to explain it.
So I'm sorry, I cut you off before. By the way, you'd only gotten through two of your four. So you went through the four types of demand, the success, tying the success of the project. What about
Right.
the strengthening the trust in the ecosystem, enabling new inflows?
Yeah, I mean, I guess I'll back up for a second, because the point number two is really important, which is, I mean, this is basically what we're talking about, which is, you know, the value of the technology is different than the value of the asset. We've learned this time and time again. And when people, when I joined crypto, still today, like when I buy something, like let's say it's an application, it's a new DEX that I think is really impressive and I think it's going to grow. Well, if the DEX grows by 100x, and there's the token that I hold goes down, then what's the point, right? And so using things like a buyback, or there are a few other ways you can do it to connect this value together. It's just so important, and I think a lot of people right now are afraid of like the securities law types of questions. I'm not a lawyer, but I mean, I think I like when tokens are designed like securities because that means that there is real value that's tied to, let's just say, the application. If it does really well, then there's a tie to my token doing really well. And if I'm wrong in my thesis, and the business gets beat out by another business, then yeah, it should go down, right? I mean, it's just it makes sense out of what sometimes is kind of a senseless market for us.
Yeah, for sure. And I think again, I'll remind people that there's nothing illegal about being a security, right? There are issues right now with regard to how you market and sell something that is not a security, and there's issues with regard to where do these securities actually trade, since the regulated securities exchanges don't allow you to trade tokens, and the token exchanges don't have the right licenses. But this is where we're headed. We're headed towards a world where these are all going to be securities or security-like, and ultimately they have to have some sort of value to make them worthwhile. And I think that's, it's sort of the paradox that we're in right now. Is like, we now know the tech works. We now know that people want it. We all know that you can have better assets on chain, but there's still the sort of gray area with regard to how do you actually do it. So it's a better gray area, I guess, than where we were before, where lawyers convinced all of token issuers that just don't do anything because you're going to go to jail. At least we're out of that realm, but we still don't have clear exact rules on how to do this. But look, even Uniswap, right, the longest holdout really ever, is now deciding to turn on a fee switch and start to give back revenue. to the token holder. So I mean, there's Hyperliquid and Pump.Fun are obviously the biggest and the most aggressive because not only do they make the most money, but they're dedicating 99% of the revenues back to token buybacks. But there's plenty of others now, right? Between your maple syrups and your Aves and your Radiums and Jupiters and now soon to be Uniswaps. So we're heading in the right direction. But how you convince the market that this is the best capital allocation and just a logical way to bring value back to token holders, I don't know. I don't know why it's so hard to convince people, nor do I know how long it'll take people to understand this.
Well, as you know, I've taken a lot of time to read into all of the drafts of the Clarity Act, which is, I mean, that's kind of what it's for, right? Is answering some of these questions, and we could do a whole a whole different set of podcasts just on that. But I think the big thing is like what you said, securities, being a security is not illegal. The reason why these token issuers could not actually register as securities is because of the cost and the just overall resources required to fill out something like an S1, right? I mean, we're talking about seed stage companies, right? Seed stage Series A. When in the regular stock market, if Uber gets to IPO, they're massive at that point, right? It's no issue at all. And the ongoing reporting is the other piece. It's not an issue, right? And so right now, it's not plausible to ask our companies to do that. And that's hopefully one of the things that the Clarity Act will change. And that's what you've seen in some of these drafts, that there will be kind of like an altered application that will make it more
Or even a safe,
simple.
right, or a safe harbor that gives you a grace period while
Right.
you're building up to a point where you have the resources and the ability to actually register.
Yeah, both of those things. Yeah. Um, but anyways, I know we could talk about that for many hours. Yeah, and then so I'm just looking back at the list here. The fourth piece, I guess, which number are we on, Jeff? I forget.
Either one. I mean, we got to wrap it up here in a minute anyway. So just close it home with
Okay,
both how this strengthens trust in the trustless system, how it enables new inflows
sure.
of capital with crypto.
Sure. Okay, that was the last one. I mean, we talked about the trust a bit, but just inflows of capital. I mean, you talk to traditional finance people all the time, potential investors or just people that from the industry. And things like Hyperliquid make sense to them, right? That's the first token where we've been getting calls from people outside the firm saying, "Hey, what is this thing?" Because it makes sense. And I think if we're hoping for a future where there's a lot more capital finally inflowing back into crypto for the first time since 2021, well, these investments need to make sense. Um, you know, you had Tom Lee on CNBC saying Ethereum is the chat GPT of stablecoins. What is that? How do you value that? And so, I can't do it either. But if you want the rest of the world to come in, you certainly need to put mechanics into these assets to where making revenue and holding the asset for a long period of time should be value accretive if you're right about your thesis.
For sure. Well, I encourage everybody to read the blog because Topher put a lot of information in there. Obviously, it's a topic we've been talking about at Arca for years. Sometimes we feel like a broken record talking about the same things over and over again, but honestly, it is inevitable that this is where the world is headed. Shout out to the guys at 1KX who put out a great report talking about just the amount of revenue being generated on chain and where that's going, and basically talking about how if you look back 3 years ago, layer ones generated almost all of the revenue on chain. And now you fast forward 2 years from now, and it's the exact opposite, right? Applications are generating almost 2/3 of all of the revenue on chain. And that's normal, right? I mean, if you think of a blockchain like an app store, obviously, as much as the revenue that's being created by Apple in the App Store, the actual companies in the App Store are generating, multiple fold more in revenue because they're the ones who are, running the companies and then putting them inside the App Store. I mean, that's effectively what Ethereum and Solana are, right? They're app stores that other apps fit inside of, and these other apps are the ones that are generating all the money. So, we'll
And
see.
and
Sorry.
Jeff, what's the collective market cap of the apps versus the networks right now?
According to this great report by 1KX that you can find, you go to their Twitter and you can find it. But it says that blockchains aggregate north of 90% of the total market cap, despite only generating 12% of the fees. And DeFi apps generate 60% of the fees and have a market cap of less than 6% of the overall market cap. So a huge disconnect right now in terms of the actual amount of value for the token compared to the money and the value that they create. So if that gap closes at all, which we think it will, hopefully quickly, it's just you're going to want to be positioned in these assets that generate all the money and use that money to buy back tokens. So anyway, we'll leave you guys with that. I encourage everybody to check out the blog. Topher, great write-up. Appreciate you doing it. You can find our blog on our website, ar.ca/blog. You can find Topher on Twitter, where he's very active, as well as in many Discords and on Telegram. But you can find him on Twitter, at least to start, at TopherGMI. Puts out a lot of great insights. So Topher, thanks for doing that. Everyone else, happy Thanksgiving, and we'll see you next week, hopefully with higher prices. Take care, everyone.